talked about a lot of stuff. Now, this time, this class, we're going to talk about is terminology. We're going to get into terminology. So, for options, when you're talking about terminology, call options. Call options are profit. You gain profit when a stock rises above a strike price. Ideal for uptrends and breakouts. Put options. Profit when stock falls below strike effective. Effective in downtrends and breakdowns. So what that means is when I'm going to bet on a call, if I'm going to trade a call, right? I want the market to go up because that's what we just talked about. A call is betting on the market to go up. A put option is betting on the market to go down. So essentially, that's what that is, okay? Strike price, target price level, closer strikes cost more but respond quicker. I said closer, my bad. So strike price, right? If we're looking at a chart and I want to get into a trade, right? Say I wanted to trade QQQ right here at 610, right around the 610 area, right? I would enter a put, but my strike price would be where I think the stock is going, right? So if I'm entering 610 puts, I think the stock is going to go to 606. I can enter 606 strike price, 607, 608, 609, 610, etc. The closer to the strike, the less volatile. The further away from the strike, the more volatile. Volatile just meaning the influx in price changing. Premium. Premium is how much a contract costs, okay? It is affected by time, demand, and price relation, right? So that's like I said, when you have a strike price that's closer, you're going to be more volatile than when you have a strike price that's further away. I mean, vice versa. If I have a strike price that's further away, my premium is going to be lower, right? Because if I'm saying, hey, I want to bet on QQQ to go down to 600, that strike price is very far away. It's going to be very volatile as it goes in the direction of me or my favor or out of the direction of my favor. It's going to be very volatile. Break even price. Call equals strike premium plus premium. Put equals strike minus premium. So when we talk about break even price, I'm going to just go to this next slide because I'd rather just show you than just to say it. Let me scroll down a little bit more. That should be good. Yeah, perfect. You can actually go down a little bit more. It's really this, yeah, it's hard to explain to you guys right now, but it's okay. We're going to get through it. I actually can do this. Sorry, guys. Receiving phone calls. There we go. Bam. Perfect. All right. So the strike price is the number you're betting on. The strike price is the exact price level you're making a bet around. So if you're going to call, you're betting the stock is going to go above the number because calls, we're hoping it goes up. Put, you're betting on the stock to go below because obviously if you're in a put, you want it to go lower. So strike 120 calls, you need the stock to push upwards towards 120 plus. Strike 120 put, you need the stock to slide down towards 120, under 120. Think of it as like a target line. Whatever side you choose, you need to price the move in that direction. Okay? Premium, the price you pay on the ticket. The premium is what you pay to enter the contract. You're basically buying a ticket to bet on the move. Premium changes based on how close the strike is, how volatile the stock is, how much time is left on the contracts, and how strong the market sentiment is, right? Oh my gosh. Sorry, guys. Sorry, guys. Okay, sorry, distractions. So, if okay, so example, if the premium is $2, which is $200, but that's how they write contracts because each contract is 100 shares. Okay, the premium is $2. The premium is in simple term. This is your entry to play the game, right? If you want to bet on calls, you want to bet on puts. That's your entry price, $200. That's not all contracts, but this is just an example. Some contracts cost $1. I've seen a contract go from $7 to like $800. No exaggeration. Because when you're trading in a volatile market, like a Trump market or a COVID market, anything can drive a stock up or down, right? So that's, yeah. But break even price, where you stop losing and start winning. Break even is the real number that matters, the point where your trade becomes profitable. Break even is strike price for calls is strike price plus premium. Puts, break even, strike price minus premium. Example, call, strike is 120, that's where you want it to go. Premium is $2, so you'll break even at 122. So if the stock hits 122, that's your break even price. Because you spent $200 on the contracts, right? And you got in at 120, so you're zeroed out. Once it hits 122, that's when you're gonna start making money. Well, as it goes to 122, you'll be making money, but break even, you'll be 122. Example for puts, strike is 120, premium is 200, so your break even is 118. It's the price level your stock has to reach before your contract actually pays you. So you're making money as it goes. It's just how much money do you want to make, right? That's the thing. So let's go to the next slide. So if you remember in the terminology, we talked about Greeks, right? We have right here, it says Greeks. Delta, theta, gamma, vega. It's something that we use to determine how volatile a contract will be, right? So delta, how strong is the push? Delta tells you how much your options move when the stock price moves $1. High delta, stronger push, contracts move fast. Low delta, weaker push, slower movement. Delta meaning in the streets, is your gas pedal. How hard your option is accelerates when prices moves. So when you look at stocks during, I would say, earnings, right? The delta and the theta are so high, they're so high. Well, yeah, they're so high that even a $5 move on Amazon will get you nothing. Sometimes you'll lose money because the delta and the theta are so high, you can never make money, right? So theta, the tax time. Theta is how much money you lose every day just because time is passing. Options lose value every night, even if price doesn't move. Fastest decay close to expiration. Theta meaning in the streets. Your contract is slowly dying. Every night it loses strength, right? So if I have contracts that expire Friday and I bought them Monday and my strike price is 120, even if the stock stays at 120, every single day, theta is going to eat those contracts alive. So we need it to move in our direction. Even if it's moving in our direction and we're still holding, unless we have like a $5, $7 move, then that's when we can talk about the data decay. So gamma is the turbo button. Gamma affects how fast your delta changes when price really starts moving. Gamma is the reason contracts suddenly go from 20% to plus 80% fast. Gamma meaning in the streets, the turbo boost when the breakout really hits. So you'll see, you say your contract prices, strike price is 122. You bought in at 120, right? Your strike price is 122. As it's moving along to 122, your gamma is pushing further and higher, right? Once it hits 122 and above, gamma is really kicking in. Like it said, you'll see the contracts go from 20 to 60%. Like in a 10 cent, 30, 40 cent move, but you sat there in this trade for $2 move and nothing. But as soon as the contract's getting in the money, that's when you're going to make some money. All right, let's get into candlesticks, okay? Candlesticks. Understanding candlesticks, okay? Let's talk about it. All right, so a candlestick shows how price moved during a certain period of time and tells you who had control, buyers or sellers. Thanks for the follow, MJ girl. Open the price when the candle started forming. It shows the starting point for that time frame. So whenever you look at a stock chart, right? Let's just check out a chart, right? You'll see red and you'll see green candles. I don't know if that's a MJ girl, Majuro. It say something. No, I'm just kidding. You'll have red candlesticks and then you'll have green candlesticks. Obviously, red candlesticks represent sellers and green candlesticks represent buyers, right? So now that you know that, this is a buy candle. Oh, my bad. This is a buy candle. This is a sell candle. Now that we know that, right? So close is the final price when the candle ended. This tells you who won the battle. Close higher than open, buyers won. Close lower than open, sellers won, right? So you have a candlestick that looks like this. This is the open and this is the close, right? Because it's closing above the open. That means the buyers, yes, bearish and bullish. You know what you're talking about. The buyers stepped in. The buyer stepped in and had a green candle close, right? If you have a red candle, that means sellers won that battle. It opened high and closed low. Sellers won that battle, right? So let's look at the chart. Let's go back. Oops, wrong button. Trading view. There we go. So if I zoom in, because I want to talk about yesterday. Yesterday was a great day for shorts. It was a bearish day. It was a very bullish day. It ended up being a bearish day, okay? So we have this candlestick. Can anybody tell me where the candle opened and where the candle closed for a red candlestick? I don't expect you guys to know, but this candle here, it opened at 609.19 and it closed at 608.17. This is also $1 candle. So that means in this level of supply, the seller stepped in. That's all that means. This level of supply and the seller stepped in, right? Because we just learned that if it's a red candle, the sellers won. Close lower than the open, the sellers won. The sellers won. Sorry, guys. So, the candle body, the thick part between open and close. This is the body of the candle, and then we call these wicks, right? So if we look at the chart again, you see these long sticks. Those are called wicks. Those are called wicks. We use wicks not to determine where the price is going, but we do use wicks to see, like, just to read the sentiment of the market or sentiment of the level we're watching, right? Because if I was watching this level yesterday, which I was, this was a major supply that it's been tested. And look at these long wicks. Like, look at this long wicks. Although the candle is green, it's still a bearish candle because the wick is so long and the body is so small. compared to, like I said, compared to the body, the wick is longer than the body, right? And it's in the weight, and it's in a supply, right? And then supply, some people call it supply and demand. Some people call it support and resistance. I don't care what you call it. It's the same difference. Support and resistance is the same thing as supply and demand, okay? Supply and so it hits supply. Look at this long wick. That to me tells me that the sellers are stepping in and the buyers can't push past the momentum of the sellers, right? It tested this level 3 times and couldn't get past this supply. Why not take the short after it gets under this level, right? Let's talk about, I want to show you guys something so we can see. Yeah. There we go. Can you guys see the whole thing? All right, bet. Perfect. So talking about different candlesticks, right? Because candlesticks have their own patterns. They have their own names. They look a lot different than each other sometimes, right? So let's just talk about what they are. Dojis shows the market is undecided. Neither buyers nor sellers are in full control. Can signal a possible reversal or slowdown in momentum. So this is a doji. Remember, we learned about the body of the candle. This candle has no body. So there's a lot of indecisiveness when you're looking at a candle like that. You don't know if the buyers or the sellers won, correct? And then you have a doji again. These are all 3 dojis. But you don't know if the buyers or the sellers won because the body is so small compared to the wicks. You cannot tell if the buyers or the sellers won. So most people don't use dojis to trade. They just use it for, not to trade, I guess necessarily. They just use it to kind of get the sentiment. We just confused. We don't know if the buyers or the sellers going to win. But that is just a key thing to look for. Because if you look here, it's no doji. Say this is a doji for sure. Buyers or sellers, you can't tell. But this is a hammer. Let's talk about a hammer. Oh, a shooting star. I'm sorry. It's a shooting star. It has a little bit of at the bottom, but I would call this a shooting star because that was my comment in the trade. You can see it's also a shooting star. It's a green star, but it's still bullish. I mean, still bearish. It's very bearish. Okay. Oh shoot, the screen wasn't on. I'm sorry. Okay, this candlestick, the candle right here is a shooting star, and this is a hammer. Right? So look at it. See? Shooting star right here. Shooting star right here. A hammer right here. Both of these bearish, right? Because if I have a hammer, or inverse hammer, shooting star, whatever you want to call it, right? If I have this is telling me that the sellers are winning, right? A hammer is a bullish sign that appears at support. Shows sellers pushed the price down, but buyers came in strong and forced it back up. That is very true. If you can see, the candle went all the way down here, shot back up. Buyers didn't allow that, and they closed it above the open. Although this candle is red, we still have the same sentiment. The sellers tried to push the price down here, and the buyers picked it up. It's the kind of the same sentiment. And if you look at this shooting star, it's similar to a hammer, but it's inverse. It's opposite, right? We have a shooting star. We have buyers trying to push the price into this level, but sellers saying no. The same thing. We have buyers trying to push the people into this level, and the sellers saying no. So look at the chart. We have a shooting star right here. We have another shooting star right here. And the cool thing about this is the shooting star came in supply. So if you trade candlesticks, you could have said, hey, I had a long wick out of supply. Then we had a shooting star. I'm sorry, I call it a hammer. Inverse hammer. But it's a shooting star. We had a shooting star, and then we had another shooting star. That shows me signs of selling, right? If I'm a bear and I want to get in the market and I'm ready to, I'm getting my put position, that's a sell sign, right? You go on to the 5 minute, you go on to the 5 minute, after you see that, look at that. Look at this candle right here. That's a sell candle. And look what happened. Selling. Selling, selling, selling. Aggressive selling. You would have entered. This is what I did, and this is what I would have did too. I would have entered 605 puts or 606 puts in the money and rode it down all day. I mean, it did VWAP and it didn't, it just VWAP. Bam. If it VWAP right here, you can get in again. Take your profits and get in again, right? And hold it down to 600. Bang, bang, bang. Now, 600 is a very, very strong support. 600 is a very, very strong support that's been tested once, been tested twice, right? Time touches. So you could have took this trade. I see. What do we see right here? What is this candlestick? What is this candlestick? We have two hammers. We have technically two hammers. Right here, hammer, right here, hammer. So, yeah, let's go. Let's move on. All right, let's move on. Okay, so now we got a Marubozu. Listen, I don't know what that's called, but I just know a full body candle with no wicks shows a strong momentum in one direction, right? And when they say no wicks, they're talking about something like this. Let me show you. Bam. Bam. This bad boy right here. Now, if you're just going to go off that for your direction of what you think the market is going to do, then you're going to kind of be in a bad position. Because although you see this candle, that doesn't mean it's going to be much, much more selling, right? Because like I told you, this is a big support zone. So if you're a new trader, oh, I see a big, big red candle, it's going to sell some more. No, did you chart a bigger level, right? Did you chart on a bigger scale? Did you chart on a 15, 30 minute or an hour? You would have knew that 600 was a massive, massive, massive demand hold, right? And guess what happened? It demand hold all the way through the night to 604. Well, all the way during the late part of the day to 604. Okay, let's move on. So now that we went over candlesticks, we got that out the way. Okay. Let's talk about understanding key levels in trading. Like I said, support and resistance, you can call it support and resistance, or you can call it supply and demand. I really don't care. It's the same thing. Support, a level where buyers consistently defend the price, preventing drops. Signs of a strong support include multiple bounces and bullish candles. Just like I said, if you did your charting, you would have known that this was a huge support level and you wouldn't have shorted into that level. You would have shorted in the supply right here. What is supply, you ask? Well, resistance, I'm sorry. What is resistance, you ask? A level where sellers step in, stopping price from climbing. Signs of a strong resistance include multiple rejections and bearish candles. Okay. Like we just said, oh man, what am I doing? Clicking too many buttons. Like we just said, resistance right there, support right there. I usually mark my resistance with red, And I usually mark my support with green. Buyers, sellers. Just make it everything very simple. And you see that big old hammer right there. That was the supply. Let me move this over a little bit. Move this over a little bit. There we go. That was the supply right here. Supply was right here, but this was the candle that told me it all. That's all I needed to see to know that it was time to get into some bear movements, the bearish market, getting puts pretty much. All right, let's go back to class. Break and retest. The cleanest entry strategy involves price breaking above resistance, returning to retest the breakout zone, and forming a bullish confirmation. And then you have trend line support / resistance, diagonal floors, and ceilings that guide price directions with bounces or rejections from trend lines, providing powerful signals. Okay, I'm going to show you both. I'm going to show you a break and retest, and then I'm going to show you a trend line support. Break and retest is what I trade. Something I like to trade. It makes sense for me, and I don't have to question it. Okay. So I'm going to tell you this trader advice. If a level is tested, it's always going to be tested again. I'm going to say always, but 90% of the time that level is going to be tested again. Okay. So let's look closely at the 628 level. Right? Or 619. Let's look at this. Let me show you. Let's see if you guys. Oh man. I'm happy I was checking and making sure. There we go. So we have the 620 level, right? So price broke under this. It was a very bearish day, and I knew that because the morning started very bearish. It's kind of hard to get into these plays right here. Whoa. Where did you go? Which day was this? Okay. This again. All right. This was Tuesday, February 3rd. February 3rd. All right. Tuesday, February 3rd. Bam. Perfect. And I kind of remember this trade very, very well. All right. So now we're looking at a break and retest trade, right? This is what we're going over, a break and retest trade. In the morning, price broke below a couple levels that I had marked, right? Even this is a small retest. I'm playing the retest right here. So, like I said, when levels break, it always come back and retest those levels, right? So I was marking. I had 619.50 marked as support this day. Hey, price comes down to this level. It's support. We're gonna buy calls right here, 619.50, right? But then I see something on the tape. I seen a break, and then I seen a retest of the 619 level, which I thought it was going to go up. Remember we talked about Dojis and the decisiveness about Dojis. That's a Doji right there. Doji right here. Indecisiveness. I couldn't enter this trade with confidence and say, hey, I like this trade because there was indecisiveness right here. The next green, but it had a hammer sentiment to me, so I couldn't get in this trade. But then I see the break again. I see the retest again, and it failed to go over this level. That's the trade right there. Although all day it's already been from 628, you have to know what you're looking at. It was a break and retest of this level, retested, and for the rest of the day. I mean, this was a great day. Let's do another trade. Let's find another retest. There we go. Right. So the break and retest is not always going to come in the same day, right? So Thursday, all these levels, right? The level I was looking at was 625 this day. I know you guys see another different levels and stuff. Don't pay attention to that right now. Price broke right here, small retest because it retested this level. It retested 625, failed to go back above 625. You could have took as a sentiment it was going to go lower, which it did. But look at this retest. We have a retest right here. It failed. But guess what? It broke up and stayed above, right? So the next day, we're trading. We're looking at things. We knew. I can't say this. Oh, man. I can't say this was Friday size because this is old. So now, all this stuff, remember I said this is aftermarket, this is pre-market. Ability to trade market and pre-market, okay? So we don't care. We do care, but we just don't mind this mess. They just trying to deter us from the trade we want to take, right? So yesterday, the previous day, Thursday, this price broke below this level. It retested it, and it failed pre-market. It failed this level pre-market. So what in our mind we're gonna do? This level is a resistance zone. It turned into resistance. And guess what? Retest right here. This is all a retest of the same level. You could have took this trade 1, 2, 3 times and held it. It stayed under the VWAP. You had nothing to worry about. Even when it off the support of 619.50, it stayed under VWAP. You stay in the trade. That's a break and retest. Okay. Trend line support and resistance. Okay. So we're talking about trend lines. I usually don't trade trend lines. I'm not a trend line trader. But I will use something. Let's do SPX. Okay, I have so much. Oxy. Let's do Oxy. All right. All right. So when people talk about trading trend lines, they're talking about trading trends, pretty much, right? So this is a great example of trading trends, trading with the market, they call it. You never want to trade the market. That's a with you never want to trade against the market, right? So I have one touches. The trend line is only 2 or more touches on an uptrend or a downtrend, because you can have uptrends and you can have downtrends. So this is a downtrend. This is considered. Oh man, I'm still using this one. This is considered a downtrend, right? If I'm looking at a trend, this is, man, my computer is being funky right now. This is a downtrend. Okay. Make sure you guys can still see. We have 1, 2, 3 touches. 1, 2, 3 touches, right? So actually, you can say 4. Bam. So this is what you call trend trading. So most people who trade trends, now I'm invested, and now I have to mark levels. Just so you guys can see, right? Technically, that's supply, right? It was support turned to resistance, turned it back into support. I know I'm talking gibberish, but just keep up, okay? So trading trends is trading the trend. So after the second touch, you can say into your head, we must be in a downtrend. You got 1 touch, 2 touch. Once price comes back and retests this line, you can take a put. It tested this line. This is your entry. Okay? But the more touches, reliable a zone is. But this is what your entry. You have a nice third touch of the resistance of the downtrend, and you have a nice hammer right there. That's a sell signal. You have another sell signal. On the weekly, if you see this on the weekly, you enter that, okay? And you have a stop loss above 47. You enter at the bottom of this candle at the close. You entered at 45. You have a stop loss at 47.5 on the weekly, okay? Let's look at it at the lower level. That's way too low. All right. So, oh man, sorry. I know I'm going so far back. There we go. So, on the weekly, you already entered the trade, right? You entered the trade right here on the third touch of the trend. Made some money, right? You held it from 47 all the way to 38. You took profit. You wait. We know we're in a downtrend, so any uptrend you see, you just wait, right? Because if it goes up this line, then now you know that we're in an uptrend and the trend's changing. But if you can see right here, what do we have? Another hammer at the third touch, a fourth touch of resistance, a trend line, a bearish trend line. That's a buy signal. Well, sell signal, but you better buy some puts. Because you can hold it from 43 to 32. That's a $10 move. Get your money. And then you see it didn't hold the support that it had, and you just banked to $12. You held it for only what 1, 2, 3, 4, 5, 6, 7, 8, 9. You got down 10 days in the downward trend line. Oh my goodness, piece of cake, right? Bam. Now, consolidating. Now we're taking a closer look at things, and we're saying, hey, it rejected the resistance a couple times, twice. It faked a breakout right here, and consolidated some more. But if you can see, it's an uptrend, right? Most trend line traders, I'm not a trend line trader, most trend line traders would have took this one because it broke out above the trend line and it retested it right here. Remember what I told you? Everything always comes back to a and retests. It broke the trend line, and we broke the trend line and came back and retested it twice on a daily. Twice. 1895. You seen that as a trend line trader, you're taking that. They're taking that. 18, they put it to 30, right? Me, I'm not a trend line trader, so I would probably for the second touch of the trend or the third. This is my confirmation right here. I have to this trade because I need to see two touches. There's one, there's two. I would take the third touch if it touches again. And guess what it did? Touch it again. I would have took this trade from 26 all the way to 51, 61. Right? You take profit off here. You have a stop loss below this trend line. Bam. You're a winner. Right? Okay. I'm done now. I promise class is over. I don't want to put too much information in you guys' head because I know it's already a lot when it comes to class and things can get very wicked. But if you did miss class this week, please just comment. Please just like. I'm going to drop the video on YouTube so you can check the video out. What else? We talked about terminology. We talked about candlesticks. We talked about strike prices and contracts and how to enter and exit contracts. I need everybody who comes to class to start your brokerage. Start saving money. Start putting money up for your savings, okay? We're young, but we're not that young, okay? If you start saving now, 20 years you'll be a millionaire. I know it sounds crazy and far-fetched, but it's serious. We have to start saving money now. Even if you put up $50 a week, $25 a week, $20 a week, anything to start saving for your future, okay? Okay. Thank you for coming to class. This was class part 2. I appreciate everybody who came out and supported and watched. I will drop the video on YouTube so you guys can check it out on YouTube. If you missed class, thank you very much for coming, guys. Peace.